is my audience. It is often said, when you know better, you do better. In previous years, I did not know about the existence or even understand tax credits. Now I use that knowledge to offset my tax liability. How would you like to lower your tax liability? In order for you, the taxpayer, to do that, you must understand why tax credits are given, the different categories, and the different types of tax credits. Let's begin by looking at why tax credits were given. Certain credits were originated in 1975 by the Congressional Budget Office. These credits were given to distribute taxpayers' burden between different incomes and people with households. For example, if a person had one child and another man had two children, the tax shouldn't be the same for the one that had the lesser children. It should be significantly lower than the one with two children. Also, the Congressional Budget Office said that these tax credits were given to stimulate economy, to influence people's decisions about working, buying houses, adopted children, so on. So now let's look at the different categories of tax credits. There are two types of categories. There are non-refundable and refundable credits. Non-refundable credits are considered by the Liberty Tax Course book as credits that are subtracted from your tax liability. Refundable credits are considered as payments toward your tax liability. Both of them will lower your tax. However, refundable credits, if you have any amount left over after your tax credit is zero, you will receive a refund. Lastly, let's look more specifically at some types of credits. We have TurboTax stating that types of credits are earned income credit, child and dependent credit, American Opportunity, lifetime learners, retirement savings credit, making work pay credit, and so on. Some of these credits are renewed, some expired, and even some modified from year to year. For example, the making work pay credit was designed to provide a stimulus, a temporary stimulus to taxpayers. Anyone was eligible. However, if you were married, filed and jointly, the tax would be $800, as opposed to single-head household, it would be $400. Currently, there's the lifetime learning credit. This credit was designed to help pay for college tuition or expenses, or any post-secondary schools. For example, if you paid your tuition, you would be able to qualify to take the deduction, or if you pay the tuition of a qualifying dependent that you use on your tax return, you can take the deduction. The IRS states that in 2014 there will be a new credit called the health insurance credit. This credit is to benefit low to moderate income families to purchase health care at a decent price. To qualify for this, you must purchase it through the health insurance marketplace, also called as the exchange. And if you're married, you must file filing jointly. To claim these credits, you must file a return. You can contact the IRS, or you could go online and seek you could seek registered tax preparers, accountants, or attorneys on pricing and other options. In conclusion, understanding tax credits may result in lower tax liabilities. We understand that Congress gives these credits to affect people, taxpayers, and economies positively. We understand that there are non-refundable, refundable. So you must consider which one will suit you, and also specifically look at which one you'll be eligible for, like the Earned Income Credit, American Opportunity, and so forth. The IRS states that there are billions of dollars in the U.S. Department of Treasury account. However, these funds are for neglected refunds from you, and you. How would you like to have your money in your personal savings account?